Hi, Joe Cantu here. Today is May 10th, 2023, and this is episode 50, a major change in the U.S. economy.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Hi, Joe Cantu here, and today is May 10th, 2023. And a major change has occurred in the U.S. economy. We would also like to announce the promotion of Ronald Liston, who was formerly a vice president for our firm, to senior vice president. He's a portfolio manager for us, and he manages the income strategy. And in addition, he is an investment advisor. Anyway, in addition to that, I'll be talking today about the economy and what's happened, why this is a significant report. And also, I'm going to have a special educational class on tax-exempt municipal bonds. So if you would like to see that, you have to go to, you have to put in Joe Cantu in your iTunes or podcast app on your phone or computer, and go to my website, YouTube website, Joe Cantu, and I will be having a class on tax-exempt municipal bonds. Why they're so important today, and well, just let me say this. We haven't seen these rates in 20 years in the United States. 20 years. And so that's why I'm providing this class for tax-exempt municipal bonds. For 14 years, in my younger days, I used to teach setting up a tax-free municipal bond portfolio for high net worth investors and retirees. This is in the days before the internet at a local college. Anyway, let's get on with the report today. So what's important is the Consumer Price Index came out, which measures inflation. And in the inflation report that came out this morning is the lowest inflation report in 2 years now. 2 years. That is measured by the Consumer Price Index, and the measurement was 0.4 for last month, equating to an annual rate of 4.9% rate of inflation. That is significant. Why is that so significant? Because it is the lowest rate in 2 years, and in addition to that, it is the first time in 2 years that the Fed funds rate, which is at 5.25%, is actually higher than the inflation rate. So if you remember, a while back, we've been seeing inflation rates of 8% and 7% and things like that. It's been coming down. But what's significant about that is that it shows that what the Fed is doing by raising interest rates, in fact, is working. And that'll get inflation under control. And that'll hopefully ease tensions in the market. Now, this report is very favorable for the stock market because, it's funny. These young money managers viewed rising interest rates as a negative for the stock market. They thought that rising interest rates would really curtail spending and really affect companies' earnings report, when in fact it hasn't. They thought that the earnings reports were really going to be heard in October and of last year, and they weren't. They didn't. And so here we are in April, and we have very, very steady. Now, earnings have come down slightly, but just slightly. And so they're very steady, very good reports, and we'll talk about that. So, earnings, it's kind of like the weather. We have 4 seasons in the weather. Well, we have 4 earnings seasons. This is kind of the way I like to describe it. So as of April, so earnings are reported in January, April, July, and October. So as of April, the full month of April. Now, earnings run for about a month and a half. So, but at the end of April, 53% of the companies had already reported earnings. And by the end of April, 79% of the companies had beat earnings consensus estimates. Now, historically, this is kind of an unwritten secret. It's sort of a secret, but it's an unwritten, it's not written anywhere where somebody talks about it, but there's this number of 70%. And if companies are exceedingly beating estimates by over 70%, in general, the business economy is healthy. Now, this is for the United States. Other countries, if you're watching this video, you will have your own number of what the, quote, secret number is for earnings. And in general, if your companies in that country beat that number, in general, your economy is healthy, or your business economy is healthy. Now, it's something to note, though, here in the United States. In the last 2 years of quarterly earnings reports, overall, the number has never fallen below 70%, and that's significant. As I mentioned last month, Wall Street analysts are noting that company earnings remain level and steady and good. And so this is now resulting in analysts raising the valuations for company target prices. I mean, it's truly extraordinary to me. I mean, I know, because I've been in the business a long time, that just because you raise interest rates, it doesn't really significantly affect earnings whatsoever. But other people don't know that, and other people who have not been through rising interest rates didn't know that. And unfortunately, they lowered the valuation. The stock market sold off. But it will come back, in my opinion, because when the Fed is raising interest rates, the markets are typically good. When the Fed is lowering interest rates, the markets are typically poor. So another important fact to note, that 79% of the report is, in fact, so we have 79% of the companies beating expected earnings as of the end of April. But that number is still higher and above the 5-year average of earnings report of 77%, and it's above the 10-year average of 73%. So what I'm saying to you is, again, as I've been touting in the previous reports that I've been giving you, is that earnings were not affected during this rising interest rate market as other people thought it would. And if you look at the 5-year average and the 10-year average, again, we're just beating earnings again. As a result, our expectations are that we believe that the stock market will move higher. We also believe that within 18 months, it will reach the previous November 2021 highs on a rebound. So that's our belief. It's not guaranteed, but that's our belief. Our actions, let me talk about that. In speaking with Ronald Liston, Senior Vice President, Portfolio Manager, and Investment Advisor, we continue to add fixed income securities back into our accounts. We are balanced managers, so Cantu Tactical Wealth Management manages money tactically rather than strategically. Strategically is the buy and hold method. We manage money tactically, which is sector rotation. We sector rotate from industries. And we are balanced managers, and we're a global manager. We fall under the category global tactical asset allocation. So we trade around the world, and we trade in so many different countries, picking up different securities. We have different securities in our portfolios right now from different countries. But as a balanced manager, that gives us the latitude to be able to move between equities and fixed income. So as a balanced manager, it also means we normally like holding fixed income as a portion of the portfolio. Now, we haven't held fixed income in the past year because as interest rates go up, bonds go down in value. And retirees who were overweighted in bonds lost money because they were overweighted in fixed income. Now, anyway, my point about that is now that interest rates are high, with the Fed funds rate being 5.25, we're adding fixed income back to the portfolios and getting back to normal for our portfolios. We do remain equity heavy and have begun, as I mentioned before, adding fixed income for greater income for our retirement portfolios. Additionally, we're adding international ETFs. Those are exchange traded funds. As China and the foreign markets businesses are expanding, and as they expand, that's good for the overall market globally around the world. We're beginning to become bullish again on technologies, and we have started to add tech funds into the account. Now technology stocks back into the account. Now that's important. And the reason it's important is in order to get back to November highs, what brought down the account values around the world is tech stocks. So money managers were selling down tech stocks because the valuations were coming down for them. Even though the earnings weren't being affected that significantly, they were selling down tech stocks thinking that they were going to come down, but they didn't. So now the same thing that brought the accounts down, now they're starting to raise those valuation expectations. So in order to bring the accounts back up to the same value back in November 2021, we have to add these tech stocks back to the account. Besides, if you look at the S&P 500, which is weighted by capitalization, by size in other words, the biggest companies in the S&P 500 are in fact technology companies. So we're adding that back to the portfolio, and that's very important to bring us back, try to get us back over the next 18 months to November 2021 highs. Also, as a note, in general, we're bullish on technology stocks overall, and we're now bearish on the energy industry for two reasons. Number one, OPEC is now kind of controlling the production. Since we have cut our production, we're having to buy more production from oil production, energy production from overseas, from OPEC. And so they are now controlling that aspect of the price of energy. And then number two, this U.S. administration's policy is to, quote, have a green environment perspective, which restricts drilling. And that also leads to inflation, or it began the inflation route, I think, in the beginning. And then now the jobs number, if you look at the jobs number, we're at the lowest. I wanted to talk about that just for a moment, but we're at the lowest jobs, or the lowest jobs unemployment rate, or a different way to say it, we're at the best employment in the history of the United States since 1969. And the jobs numbers continue to support that. Anyway, that concludes my presentation. I did want to put it out there. Again, I'm going to have a class on tax-exempt municipal bonds. You can see this video, or you can have podcast if you're driving and don't want to see the video. Just you can put this podcast in and go to your little app for podcasts and type in Joe Cantu. Anyway, have a good day. I have some disclosures at the end, but have a good day. Thanks. Bye.
Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management and Joe Cantu are a fiduciary firm and registered investment advisor in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.